G'day and welcome to this week's video. My name is Ashley Rowan and I'm a financial advisor with Consortium Private Wealth. Today we're going to be looking at the financial secrets for each phase of life. So it's a bit of an overview of the types of advice we provide our clients and very specific to which phase of life they're in, which could be could be from teens all the way through to retirees. So to kick things off, a quick disclaimer that this is just purely general information only and not specific to your situation specifically. Let's start with teens and young adults. So what we generally suggest to people in this space is, it's all about education and it's all about starting young. And we try and educate our clients that investing and reinvesting earnings has a huge impact on investment balances in the future. So the magic of compound interest it really is the forefront of our advice in respect to teens and young adults. So what we've found is that most young people don't want to think about life in 50 years time, but we bring up this scenario that, let's say a 15-year-old starts saving just $10 per week into an investment, and let's say that investment returns 5% per annum. Now when they turn 65, they would have invested, so that $10 per week, they would have put forward about $26,000. However, their investment would have grown to over $116,000 just through the compounding rates of return. So it has a huge benefit to start young, and this investment could grow further if it was in a tax-effective environment such as superannuation. So we look at these opportunities for our young clients as well. Moving on, for those, let's say in their early 20s, early to late 20s, and at this stage maybe still single, saving is still a key strategy, as careers are established, but usually with a shorter time frame and a specific purpose in mind. And this could be, buying a car or saving for a home deposit. But these strategies can be undone by the lure of desirable things and ease with which one can go into debt. So that buy now, pay later schemes, high interest credit cards. So what we try to do to clients in this category, don't indulge, don't buy what you don't need, work out a budget and stick to it. Now let's say moving on to late 20s, early 30s, maybe early 40s as well, the focus is on family and raising a family. So what we try and suggest to our clients in this space is not only they're taking care of the superannuation and respecting budgeting and savings, but really look to protect what they've got in place and their wealth accumulation and investment goals and objectives. And our focus here is on making sure they've got good quality insurance in place to protect their situation in the event of something major were to happen, from a health related point of view. And the insurance we look at can be life insurance, total permanent disability cover, income protection, through to trauma cover. And thankfully, to help with cash flow, because this is a difficult time when we've got mortgages and we may have kids, to protect cash flow, we can look to own the majority of insurance within superannuation. So that definitely does help. So at this point, family focus, we're protecting our goals and objectives by putting in force some really good insurance. Moving forward, preparing for retirement. This could be someone in their family in their 50s, maybe 60s, and it's all about supercharging their superannuation or retirement assets. So what we look at here is, surplus income, ability to make additional super contributions. This could be in the form of salary sacrificing if we're looking for tax deductions. Really ramping up what we can get into super while we're still working. And another strategy we also explore is, at this stage, if people are carrying debt into retirement or looking to pay off their existing mortgage or home loan as quickly as they can, we look at the benefits of redirecting those extra payments into super by salary sacrifice in preference to paying off your home loan quicker. We're looking at that because home loan interest rates at the moment are at record lows, 2 or 3%. If we're making additional contributions into super and getting good investment returns, it may work a little bit harder considering that method. And hey, when you're retired, you can take out a lump sum to clear out the home loan anyway. So we're exploring these options, but the common theme here is supercharging your super. And finally, in the golden years, we've got to understand the Australians are up there with the leaders when it comes to enjoying long and healthy retirements, and we're living longer. which is the main sort of outtake of this particular slide. So what we suggest to our clients is don't draw down on their super funds or retirement assets too quickly, and not as much. Don't enjoy yourself too early on. Enjoy yourself, but don't cash out your superannuation fund. It's got to last the journey, and you've got to budget it through. Retirement, in some cases may be 20, 30 years. So it's a long-term investment, even once you've decided to retire. And what we've also suggested to our clients is don't invest too conservatively. It's difficult at the minute to find, to chase income. So for example, term deposits aren't paying us too much of an interest rate. With all the volatility due to COVID-19 at present, a lot of companies aren't paying dividends. So we're not in an area where we could invest very conservatively and still get a good rate of return. We need exposure to growth. So once again, education is important. Ensuring clients have exposure into defensive assets. I'm not saying it's not a good part of the portfolio, but we need exposure into growth assets, and that could be international and Australian equities. So there's some of the tips we generally recommend to our clients through each phase of life. Obviously, you may be suitable for only one or two of those, but definitely keep it in mind. And if you need any more information, have a chat with your financial advisor. Thanks for watching.